Dear students, today we are going to discuss the topic about holding company accounts. Holding company accounts is an important chapter in corporate accounting for UG courses. Not only for the UG courses, if you go for the professional courses like CA, ICAA, and CMA or any other professional courses, that holding company accounts is an important chapter. That holding company accounts are otherwise known as consolidated financial statement. Consolidated financial statement. Okay, now I am going to explain the concept of the holding company accounts and how we have to prepare the consolidated balance sheet. I am going to clearly explain about how we have to prepare the consolidated statement, what do you mean by holding company, what do you mean by statutory company, right? So how that consolidated financial statement should be prepared. Okay, if you take the companies, due to the competition, due to the technological advancement, the company taking lot of efforts to overcome the competition, to to face the challenges in an organization. So they are taking different strategy to strengthen their business, to take the business into the next level. One of the strategy, they can simply hold the majority of the shares in another company. Instead of go for the purchase or acquisition of business, the company simply hold the majority of the shares in another company. Why the company go for the holding the majority of the shares in another company instead of acquisition of shares? If the company go for acquisition of shares, then the company have to meet out lot of legal procedure and formalities to acquisition of business. So the company, they don't want to take the risk, and then they don't want to go for the lot of legal formalities. So instead of acquisition of business, the company go for holding the shares in another company. Let me explain the meaning of holding company, right? Holding company is a company which control majority of the shares in another company. The company hold the majority of the shares in another company. It's called holding company. Either they may hold the majority of the shares, or the controlling the composition of board of directors. Okay, so for an example, A company purchase 70% of the shares in B company. In this case, for B company having, for an example, 100% shares, out of 100% shares, nearly 70% of the shares held by company A. It means one company purchase majority of the shares in another company. That company is called holding company. How can we decide the majority? That percentage level is 50%. If company purchase more than 50% of the shares in any company, that is called holding company. Suppose if the company purchase less than 50% of the shares in any company, in that case the holding company procedure should not be applicable. The holding company concept should be applicable only if the company purchase more than 50% of the shares in another company. At that time only that holding company concept are applicable, right? Either they may hold the majority of the shares or the controlling the composition of board of directors. Right. Now, so holding company, those company holding the majority of the shares in another company is called holding company. Now come to the meaning of subsidiary company. Subsidiary company means those company giving their majority of the shares to another company. That company is called subsidiary company. I repeat, subsidiary company means those company gave their majority of the shares to the another company. It's called subsidiary company. For an example, there are two companies, company A and company B. In this case, A company purchased 70% of the shares in B company. In that case, A company holding 70% of the shares in B company. So, in this case, A company is called holding company. B company is called subsidiary company. Why B company is called subsidiary company? Because out of 100% shares held in B company, they are giving 70% of the shares to A company. So remaining they are kept only 30% of shares. So subsidiary company means those company giving the majority of the shares to the another company is called a subsidiary company. Now I am going to explain the steps involved in preparation of consolidated balance sheet. So it means the holding company, after holding the majority of the shares in another company, in what way or otherwise how they have to prepare their financial statement after holding the majority of the shares in another company. Means after holding the shares in another company, how they have to prepare their financial statement and how it should be presented, that we are going to study in detail. Right. These are the steps should be followed by the holding company at the time of preparation of consolidated balance sheet. This step 1. Computation of or calculation of holding minority ratio. In the first case, the holding company, they have to calculate holding minority ratio. How they can calculate the holding minority ratio? First, they have to take the number of shares available in S Limited. Once they finalize the number of shares in S Limited, then how many shares given, then S Limited, how many shares they are going to give to the holding company, or how many shares holding company purchased from S Limited, and how many shares kept with S Limited. For an example, S Limited, it's for subsidiary company having 1000 shares. Out of 1000 shares, 700 shares purchased by holding company. So remaining 300 shares kept with subsidiary company. So out of 1000, 700 shares holding by holding company and remaining 300 shares kept with subsidiary company. In this case, holding minority ratio is 7:3. Step 2. Calculation of capital profit. How can we calculate the capital profit? For calculation of capital profit, we should know the date of purchase. When the holding company purchased the shares of subsidiary company, the date should be determined. The date should be identified. Okay. Once the date should be identified, before the date of purchase or before the date of acquisition of shares, purchase of shares, what are the profit they are having, that portion is called capital profit. So what are the profit earned by the company before holding the shares in subsidiary company, that profit is called capital profit. Okay, normally the capital profit may given in the adjustment, or it may given in the balance sheet. So suppose if it's given in the balance sheet, we have to identify the date of that profit. Okay, so if the profit is given before the date of purchase or before the date of holding, then that is called capital profit, right? Step 3, calculation of revenue profit. It means after the date, we have to identify the date of holding. After the date of holding shares, what is the profit earned by the holding company? That should be taken as a revenue profit. The revenue profit, it may given in the balance sheet. So you have to check the date of purchase. So that after the date of purchase, what is the profit earned by the holding company after holding the majority of the shares in another company? That profit is called revenue profit. Normally, that for the calculation of both capital profit and revenue profit, they may take the two component. The first one, profit and loss account, and second one, reserve. So they may take the two headings. The first one, profit and loss account, and second one, reserve. So what is the profit given under the head of profit and loss account, and reserve should be taken, and that particular head, what are the profit portion related to before the date of before the date of holding, that should be taken as a capital profit. After holding, what are the profit related to after the holding of shares is related to revenue profit. Next, calculation of minority interest. Minority interest means you have to think about from the subsidiary company point of view. The subsidiary company, after giving their majority of the shares to the holding company, what are the rest of the portion they have kept with them, that is called minority interest. So minority interest means the portion of that rights or the portion of the subsidiary company's profits and shares after giving the shares to the majority shares to the holding company. For an example, if you take the shares out of 1000 shares, 700 shares they are given to holding company, so remaining 300 shares. So take the 300 shares and then face value should be taken. And if you come to the capital profit, in capital profit, that subsidiary company portion of capital profit should be taken. And if you come to the revenue profit, subsidiary company portion revenue profit should be taken. So there are three components should be taken: the face value of shares in subsidiary company, capital profit of S Limited means subsidiary company, and revenue profit of subsidiary company. If we add these three, then we may get minority interest. This minority interest should be shown in the liabilities. In balance sheet, it be shown in the liability side. Okay. Next one, calculation of cost of control. The cost of control means not to think about from the holding company point of view. The holding company, to control the shares or to hold the shares in subsidiary company, how much amount they have paid and what are the things they get back after holding. For example, to hold the 700 shares, how much amount they have paid. For example, to hold the 700 shares, they may pay 10,000. To hold the shares, they may pay 10,000. So that should be taken. So the holding company, to hold the 700 shares in subsidiary company, they have spent 10,000. So that be taken 10,000 less. After spending 10,000, what portion of shares they may get? For example, they may get 700 shares. So that should be taken. So 700 into face value 10, 7,000 shares. So after spending 10,000, they get the 700 shares. The face value of 700 7,000, and the capital profit of H Limited holding company should be taken. So for an example, the capital profit of H Limited 2,000. So in the name of shares, they may get 7,000. In the name of capital profit, they get 2,000. So 7 plus 2, 9,000. So to hold the 700 shares, they spent 10,000. They got 9,000. It means in the name of shares they got 9,000. In the name of capital profit they get 9,000. So they spend 10,000 but they get 9,000. Remaining 1,000 should be treated as a goodwill. It means the holding company give rupees 1,000 to the goodwill of the subsidiary company. So the remaining portion should be taken as a goodwill. Suppose if they get any excess amount, that should be treated as a capital profit. And then step 6, calculation of unrealized profit. So the calculation of unrealized profit should be calculated from the stock. So in unrealized profit, either the profit on cost or sales, that should be identified. And then next one, elimination of intercompany debt, or elimination of or otherwise is called as calculation of mutual obligation. So the mutual obligation should be calculated and it should be adjusted. And the last one, after preparing all these working note, after completion of all these steps, the company they should prepare the consolidated balance sheet. In consolidated balance sheet, in liabilities, there are three major heads. Head number 1, equity and liability, and head number 2, non-current liability, and head number 3, current liability. Under three major heads, there are some different subheads there. If you come to the asset side, there are two major heads: non-current assets. Under the non-current assets, tangible assets, intangible assets, and second category, current assets. Okay, so these are the component in the consolidated financial statement. Here I am given the format of the consolidated balance sheet. Okay, this is the format, this is the image or is the format of the consolidated financial statement. Thank you.